War. You've seen the headlines, the massive conflagration that took place when the US and Israel decided to strike Iran. When it comes to geopolitical disruption, though, this is nothing new. Over the past few years, you've seen the Russia-Ukraine war and the Israel-Hamas conflict. But this event has struck closer to home. And the reason is fairly obvious: crude oil and India's dependence on the West Asia region. The effect would have been visible in your portfolios. Now, I know that this is a developing story, so we're not going to talk about specific events that have unfolded so far. We'll instead talk about why this conflict is different from the others in the recent past and what your response to geopolitical crises should be. In the recent past, a lot of you would have looked to diversify your investments abroad. How does this affect you? Is it better to do nothing? Because this is a pretty underutilized response. Or should you adjust your strategy? And how should you do it if that is the case? Join me to talk about this is Kirtan Shah, the founder and Chief Executive Officer of Truvantha Wealth. Kirtan, thanks so much for taking the time.
Alex, thank you so much for having me as always.
So, underrated response is to do nothing. Do you see people utilizing it?
I think a better response is to be able to buy the fall, because historically, if you go back and see for the last 26, 27 years since the 1999 Kargil war, I think all wars have been a great opportunity. And I'm sorry I'm saying this, but this is only in context to investments, right?
Yeah.
I have some data, and because it is too much, so I'll have to read through from the phone. So I've done some homework. When the 1999 Kargil war happened, the peak drawdown for Nifty was 6%. But 1 year later, and I'm talking about peak that it achieved, was 29% positive returns.
From the low to the peak.
From the low to the peak. March 2003, the Iraq war, again Nifty was down 5% at peak drawdown, but at peak rise, it was up 71% a year later. You look at March 2014, again Russia, Ukraine, same, Nifty was down 2%, and a year later, at the peak, it was up 38%.
Wow.
You look at Feb 22, again Russia, Ukraine, was down 12%. It recovered that 12% and was up 4% in the next 1 year. October 23, Israel, Hamas, you made a mention, 3% down at peak, and 1 year later up 26% at peak. And India, Pakistan, that happened the last year, right? Down 5% at peak, and we are still, at the time of recording this, we are still up 2% over last year after having recovered the 5%.
Interesting. So we've recovered. So buy the dip is the answer, but of course, it depends on the scenario as well, right? And this situation, you haven't had a conflagration like this in the Middle East or West Asia from our perspective in a very long time. It's the largest such situation in this century. So what is at play right now from what you've looked at? And neither of us are geopolitical experts, let's put that out there. But from the perspective of the Indian investor and the advice that you've been giving to people as well, that is based on certain reading. How are you reading this?
I think a very interesting question, and I have some data points that I can share with you. Look, the only problem that we see in this war is oil, right? Because the Strait of Hormuz and various other things at play, taking care of 20% of the seaborne oil that passes through that narrow canal. And crude we've already seen go up. At the time that you and I are recording, I think crude already is at 83.5,
yeah.
Right? But let's take a step back. In 2007-8, our GDP was roughly $1.16 trillion. Our oil import bill was close to $68 billion. That is roughly 6% of our GDP. Today, in FY26, the estimates are that we'll close our GDP numbers at $4.2 trillion, and our import bill is $120 billion. That's 3%. So versus 2007-8, as of today, our import bill versus the GDP has drastically gone down. So the impact is not going to be very significant, point one. Let me give you a recent past example. If I take you back to Feb and March of 2022 specifically, crude went up from 77 to 139, which, if I'm not wrong, was a 14-year high for crude at that point in time. Nifty corrected close to 5% that time. So the point that I'm trying to make is, yes, crude is a big impact on India. And the assumption is that if crude prices go up, stay up, it'll increase inflation, and hence you might not be able to do a lot on the macro factors. But if you look at today, our WPI is close to zero. So even if inflation goes up, it's not really a very big challenge. 1.25% rate cut has already happened the last year. And I don't see a reason why immediately rates will start going up, even if crude stays where it is at an elevated level. So I think all of these data points put together, I think, looks like an interesting opportunity, and it does not really give us any discomfort as to why should you not buy lowers. Because if you look at India equities, from a valuation standpoint also, it's become much better than it was.
I was going to ask you, because we've reached this juncture where, again, at the time of recording this, you have the Nifty 50 at close to 24,800, right? And so we've recovered from the low point already. The question that I have is that it's been a pretty torrid last 12 to 14 to 16 months, right? The equity markets in India have done practically nothing. Yeah. And just at a time when, at the start of 2026, you were looking at a situation where fundamentals in India were changing, the argument that valuations are stretched in the broader markets was getting a little softer, if anything. Yeah. And we were poised to see green shoots and things improving. At that time, this thing has come about. So it's not been very long since the conflict started. So therefore, would you say that the argument to double down on India has gotten louder?
I'll give you a slightly longer answer.
Yes, please.
So what has happened over the last 18 months, to be very specific? You saw the global markets go up, India didn't do anything, right? Yeah. The point one is for us to understand, why did India not do well? India did not do well is because valuations were pretty high. And we'll have to accept that fact that the valuation was high.
It is true.
And it was cheaper globally, which is why FII sold and took monies away.
And this is because of post-COVID, whatever we did.
Absolutely right. Also at the same time, we've actually not have had a negative year since 2015. So look at it in context that each year since 2016, you've been giving positive returns. So if at the end of the 10th or the 11th year also, you've actually not drawn a -10 or a -12, in itself is a big win, right? That's one. But comparatively, where we were 18 months back versus where we are today, our 10-year premium to EM markets has become zero now. We are exactly where we would have otherwise been if there was no premium versus the EM market.
Explain this. So some people will listen to this and they'll be like, yeah, that's cool. But explain why this is significant.
So again, last 18 months data. Nifty is down 5%. You see the PE at Nifty down 10% from the high, and EPS is up 6%. So now this is the Nifty equation, which means that while over the last 18 months your stock market did not do well, it fell 5%.
Yeah. So, but just to drive home that point, I want to make sure that everybody understands what this means, right? So while what you're saying is that the price to earnings ratio is down 10% from the peak, at the same time, the earnings per share, which is a part of that price to earnings calculation, has gone up. So a price to earnings multiple can go down for two reasons. Either you will have a situation where prices go down, or you have a situation where earnings goes up significantly. Both of those things have happened.
Absolutely. Not just the Nifty 50. I think Edelweiss MF shared a very interesting data point for mid and small as well. In mid caps have fallen 4%, but the price earnings, PE is down 30%, and EPS is up 35%. Right? Mad. Look at small caps, down 15%, PE is down 25%, EPS is up 10%. So now we are in a situation where we are saying for the last 15, 18 months, we've time corrected. Our valuations versus EM have lost our premium for the last 10 years. I mean, we always traded at a premium to the emerging markets. But now because emerging markets have done so well and India has not done so well, that premium has vanished from a 10-year average perspective. I see no reason why you shouldn't or you wouldn't want to double down, right? Because the war data that we discussed, the oil data that we discussed, the valuations that we are discussing, I think all of that is panning towards making sure that if you have 3-4 years, 5 years of investment horizon, Of course, be okay with volatility given the situation that we are in, and depends on what is Trump doing every second day. But I think it's a great entry point given where we stand from an India standpoint, for sure.
Okay, so let me ask you this question, right? And we'll come to what a new investor should do as well. Looking at the screens right now, there'll be a little bit of maybe opportunism. There'll be also on the other side a little bit of trepidation to say that, oh, markets are so volatile, what do I do? So over the last several months, I've been looking at updates on social media where a lot of people are exhorting Indian investors to look overseas and to say, diversify, diversify, diversify. And I have constantly felt that while it is a good idea to diversify, some of those calls might have been a little too aggressive. The reason why I'm thinking about this is that you've had a situation where you've been curtailed on account of the RBI as well as the SEBI.
Yeah.
You can't invest through mutual funds. You would have had to go through LRS, or the Liberalized Remittance Scheme. And you've seen a lot of these markets go up very, very substantially. Kirtan, you pointed that out. And just over the last week and a half, you've seen the Kospi in South Korea crash through the floor, trading halted, and the next day up 12%. So there is considerable volatility in these markets as well. If you're looking at incremental allocation from this point, would you be more cautious on international as compared to India?
See, I think a theory answer is for you to have 15-20% of your allocation globally.
That's it.
That solves most of your problem, right? There are two reasons why people invest globally, if you and I have to really argue on the point. First is, of course, the rupee depreciation.
Correct.
So if you're invested in the US and the US markets are making you 12%, but the rupee is depreciating by 3%, you will end up making 15% in rupee terms. Good reason for you to diversify globally. Another reason for you to diversify globally is because there are going to be themes that you will not be able to play in India. Like say, for example, we still have a very nascent EV market, AI market, right? And we've seen how probably, because you named Kospi, right?
Sure.
It went up 100%. And largely it has happened because 40% of the index is by two stocks.
Samsung is one of them. What is the other one? I can't remember.
It's HK something. I mean, I also don't remember the name. But only two stocks hold 40% of our 40% of the index.
And that's not just Kospi, it's concentration across the board, even in the US.
You look at US, the top 7 tech stocks are the reason why 60-70% of the US market returns have been delivered. So I think there is so much of concentration to themes that have really played in the global markets that is enticing a lot of people. But it is very largely like FOMO, right?
It's classic recency bias.
Exactly. You look at gold and silver, and now if you look at the gold and silver rally and you want to invest, probably I'm assuming the story would have already played out, right? Now if you're going to invest in global markets because you've looked at what happened in the last 1 or 2 years globally, I think you are very late in terms of investing. That's one. Second, also that people have to understand is, outside of the US markets, how many of us really even understand or know of companies? You ask me which was the second company, I don't even know the second company.
And you're tracking the space, right?
Yeah, and I'm tracking the space. Not that I don't know, it's just that I can't remember it right now. But that's the whole point. I mean, if you're going to invest in Latin America because it generated 50% returns over the last 1 year.
And Brazil has...
Name 3 companies that people know of, right? So don't get carried away just because some markets have delivered return. I think having an India exposure and outside of India around 15-20% specifically in the US largely solves your problem, because US will end up playing most of these themes for you and at the same time will pay you for the rupee depreciation. Of course, we can argue why not China. The problem with China is that, you know, while the per capita is growing, GDP is growing, it's not translating into stock market profits. In spite of the last 1 year being, let's say, 25% kind of returns, over the last 5 years, it is still 4.5% CAGR.
And
in
there are
dollar
certain
terms.
problems that they continue to have. The whole anti-involution piece,
Absolutely.
the massive capacity in their factories and not utilizing it. Their demographic dividend is gone completely out of whack. A lot of older people there
Absolutely, and which is why people in this space typically keep saying that like I quoted, GDP going up, per capita going up is okay, but is the ROE ROC really translating into stock price return? The answer is no. So while you do global investing, I would rather urge people to stick to geographies that they understand, names of the stocks that they've heard of, instead of trying to do something just because it has moved up in the past. Because first, you have very limited options available to explore that market. Second, there is too much of ambiguity in terms of paperwork, taxation. And
What is your preferred
filing.
route if you were to invest abroad? How do you go about it?
Technically, you do it through ETFs, but the problem is, like you rightly pointed
Yeah.
out,
The
RBI,
limitations.
SEBI has blocked the limit because at the industry level it was 7 billion. It's already been taken care of since a long time, if I'm not wrong, since 2022-23.
It's not moved.
They've not opened. And hence ETFs are trading at a price much
Premium
higher.
to NAV, yeah. Premium to
You can actually use the GIFT City route, but also, again, like I said, there are very limited options available in the GIFT City route also.
But they're growing now.
They are growing, and of course, I will not be surprised that over the next 4 or 5 years, you will have a very large pool of funds who would kind of set up base in the GIFT City, and they will give you exposure to do investments globally through GIFT City. But as of today, that you and I talk, these options are not available.
I must also, sorry, you're making a point.
And even if these options are available, I would still stick to the whole point that we discussed, right? That you want to invest in the US markets and not probably a Kospi or a Brazil because it has moved up.
Sure. Okay, that's fair. I do want to also ask you about gold. And we've talked about this in fair detail in the past. And I must say that before the entire crazy run took place, we've spoken about gold, right? And you've talked about having an allocation, again, similar argument, 10 to 15%, preferably in gold ETFs or gold mutual funds. At the time, I think we've even spoken about sovereign gold bonds, but it's no longer available. But having said that, we've talked about how this is also a hedge against rupee depreciation, which is incredible, right? So, but incrementally at this point, what should the strategy be? One would assume that with geopolitical tensions so high, gold will continue to have safe haven demand, but it's run up so much.
I think whether or not should you invest in gold at this point in time is a very tricky and a difficult question to answer. I would rather like to flip that question saying that if you heard a stock the last time and you've bought gold,
then it's good.
How long should you continue to hold gold? Right? There are two data points that I would personally look at if I am holding gold today. Right? First is, of course, I want to continue to look at central bank buying, because that's one of the primary reasons why gold really went up. And these data points are available every month and very easily available. And you just Google and you will get the data.
Sure.
So if you see a couple of months where probably a China and an India has not bought gold, that probably can be a red flag for you to kind of liquidate or trim down your gold positions. And very importantly, I will look at US very specifically in terms of real rates. If real rates in the US go up, probably the gold bets are off the table. I'll explain that.
Real rates.
If you look at 2011 to 13, you look at 2020, and you even look at the past gold rallies. Most gold rallies have failed when real rates in the US have went up. Now, what is real rate?
Yes.
6% is your return, 4% is inflation. So you say 2% is what stays with me.
Sure.
That's really what I'm making.
Yeah.
So let's call that as the real rate. Now, this real rate can move up in two situations. Either your interest rates are moving up. So instead of 6, your interest rate becomes 7. Your inflation is still there at 4. Your real rate will become 3.
Yeah.
So if interest rates start moving up, your real rates will go up. Or inflation falls. So your interest rate is 6, but your inflation instead of 3 becomes 2, right? And hence your real rate will become 4. If any of these two situations happen where interest rates are increasing or inflation is falling, your real rate is increasing. And real rate increasing has historically proved detrimental to gold rallies.
Sure.
Now, of course, I'm not sure if people who are watching us are sophisticated enough to understand this, that you don't actually wait for rates to go up. or you don't actually wait for inflation to fall. The day you start hearing commentary, like say for example the nominated Fed chairman Kevin Walsh, when he was at the position in Fed the last time, he was actually the one who was against quantitative easing.
Sure.
And which is why if I can take you back a month and a half, so
There was a reaction in the bond
yes,
yields.
when the nomination was made for Kevin Walsh, you saw gold fall seriously over the next 2-3 days just on nomination. Because if he's going to come into power, and if you just extrapolate what he did in the past, he's somebody who wants to control inflation and increase rates, reduce quantitative easing. All of this is going to increase real rates. So if you see that the new Fed chairman comes and starts talking about these things, right, you know probably that you will have to probably trim down on the gold position that you have. So real rates and central bank buying are two cues if you are holding for you to
So
decide.
I want to spend the last leg of this conversation talking about tweaks and adjustments that you might want to make in your portfolios, because as you've very ably described, Kirtan, markets move ahead of events, and so therefore you might just be left holding the bucket, so to speak, and things would have gone past, or you might miss the bus, right? So, and this is not creating FOMO, this is simply hopefully preparing people for what could happen. Two scenarios for you. One, you've got a portfolio right now. You might have gotten overexposed to certain pockets. And I think to a certain extent, the overexposure to small caps has gotten corrected over the course of the last year and a half. You've already spoken about foreign. Gold is something that you've spoken about. So you've got an existing portfolio. How do you adjust? You've got no investments yet, and you're looking to start right now in the mutual fund space. What is your advice?
I think from an adjustment standpoint, I'll tell you what I'm currently doing for ourselves and clients. So we've always held 20% gold for clients' portfolio for as long as we've been in the business.
Through ETFs?
Yes. And our objective of holding this gold has never been the kind of return that gold ultimately offers you as a product, but to be able to buy equity markets lower. Because typically you will see, and I'm sure a lot of people hearing us will relate, markets fall 20% and you know, being an investor for a long time, that you want to invest more money. But you never have more money to invest when the markets fall. And in such a situation, gold is actually what really plays for you, because when the markets fell, either gold was stable or gold went up. So your objective is for you to be able to remove gold and start buying equities at the lower level. I think we've started doing that for our clients' portfolio. We've also started liquidating a lot of our US exposure that we had globally and started buying India equity. And most of this money is going to large and small cap space in India.
Not mid cap. Why not mid cap?
Mid-cap, like I said, mid-cap valuations are great. I told you it's fallen 4%, P's are down 30%, EPS has gone up 35%. But there is a problem with the mid-cap space in India, given the way AMC ecosystem is structured, where most of this money goes to that 150 stocks, right? So for us, mid-cap is
overcrowded.
Is a momentum play.
Okay.
And we don't see a lot of liquidity at this point in time. So we feel that play that will work out is most probably value, right? Because if FIs come back, they'll buy large caps first. So for us, the theme that we are playing is more value and less momentum. So that is what we are doing.
And value is done well over the last decade. I think 7 out of 10 years it's done well, right?
I think if problems continue to be the way they are, I think value will do much better than momentum in general. Okay. If you are new and you have absolutely no investment at this point in time, then ideally my suggestion to you is to have 80% in equity and 20% in gold. Don't buy gold lump sum at this point in time. Buy it through SIPs over a period of time. Of that 80% equity, you might want to do 60% India domestic and 20% global.
No fixed
which
income?
Is largely... so for us, fixed income is the problem that gold is actually solving.
Sure, okay.
Of course, this is easier said than done, and this is slightly more aggressive portfolio for somebody who has 8-10 years of investment horizon. But even in the domestic play, we very firmly believe that you should split across large, mid and small equally. So 60 is split across large, mid and small equally domestically. 20 is more global. largely US, and 20 is more gold. But on gold and the US, you start doing it through an SIP over the next 1 year, 18 months, and not do lump sum. And domestic, you can do lump sum in large and small cap space. Mid cap, you would want to go staggered. That's what I would suggest to somebody who's starting new.
Yeah, and this is, by the way, this is just one way of looking at it. You could, for example, theoretically, hypothetically, you could look at having gold exposure to through a multi-asset fund.
Absolutely.
You can have, through that, both equity as well as fixed income allocation, potentially with equity taxation. So there are several ways to play this. The broad thesis is what you've described it. And I think it's been a very engaging, interesting conversation for me. Thank you so much, Kirtan, for taking the time.
Thank you so much for having me, Alex.
All right, well, that brings us to the end of this edition of Money Wise. Let us know what you think and do stay tuned. This is NDTV Profit.